Welcome to vTalkInsight, Risk Sentiment Daily for December 11th, 2025. Markets are digesting a Federal Reserve rate cut, renewed liquidity support, and a powerful AI investment cycle, all against the backdrop of rising long-term yields and mounting fiscal worries. In the next few minutes, we will unpack how this late cycle mix is shaping risk appetite across equities, credit, and rates, and what it means for the balance between opportunity and vulnerability. Risk sentiment today looks late cycle, but still constructive. A combination of Fed easing, solid earnings expectations, and an AI-led capex boom is keeping risk assets supported, even as structural risks around debt, yields, and policy uncertainty grow louder. Equities have pushed back toward highs, and earlier volatility around the Federal Reserve meeting has faded, reflecting how investors interpreted the latest policy move as broadly supportive rather than a clear break in the risk narrative. Beneath that headline strength, the backdrop remains two-way. On the positive side, the Fed has already delivered a cumulative 175 basis points of cuts, begun targeted Treasury bill purchases to maintain ample reserves, and signaled that goods inflation is easing, all of which encourage markets to treat the path ahead as one of gradual policy support rather than renewed tightening. At the same time, long-term sovereign yields are elevated, fiscal deficits are large and persistent, and political pressure around the central bank and future leadership is rising, which together are keeping term premia and risk premia from compressing too far. Compared with recent days when investors feared a hawkish cut and a sharply higher for longer profile, the realized outcome has reduced near-term downside tail risk for growth assets but not removed it. The result is a market that still leans toward carry and risk exposure, yet with a visibly thinner cushion, tight credit spreads, ambitious equity valuations, and pockets of speculative behavior mean that any disappointment around policy, growth, or inflation could flip sentiment more abruptly than earlier in the cycle. A central bullish driver is Fed easing and ample liquidity support. The Federal Reserve has now cut rates by a total of about 175 basis points, including the latest quarter-point move, shifting from an outright restrictive stance towards something closer to neutral as inflation has moderated and labor market data softened. Even though the latest decision came with 3 dissenting votes and a dot plot that points to only one additional cut next year, markets reacted positively. Equities and bonds rallied, the dollar weakened, and risk assets broadly treated the combination of a cut plus cautious guidance as evidence that the Fed still has investors' backs, rather than signaling an imminent pivot back to tightening. Beyond the policy rate, the Fed is reinforcing that message through liquidity tools. It is set to purchase around $40 billion of Treasury bills in the first month alone, with elevated buying expected for several months to maintain ample reserves and stabilize money markets, while standing repo operations now effectively have no aggregate cap. Incoming inflation data and pricing support this easing bias. Headline and core PCE are running below 3% year-on-year. Goods inflation was notably soft in November, and tariff-related price pressures are expected to fade over the next year, leading many participants to see current market pricing for rate cuts and a terminal policy rate near 3% as broadly rational. There are, however, limits to this bullish story. The Fed does not expect to hit its 2% inflation goal until around 2028. Services inflation remains sticky, and several officials favored either no additional cuts or even a possibility of a hike, underscoring that the bar for further easing is rising. For markets, this mix suggests an environment that is supportive, but not exuberant. Lower front-end rates and ongoing liquidity operations are friendly to carry trades, credit, and emerging markets, especially with a somewhat weaker dollar, but elevated long-term yields and a data-dependent Fed keep a clear ceiling on how far valuations can stretch without fresh fundamental progress. The second major bullish driver is an AI-driven capex and productivity boom. Across technology and beyond, companies are committing extraordinary sums to AI infrastructure, with one estimate pointing to roughly $3 trillion of investment over 5 years, about half of it expected to be financed through debt markets. Concrete examples are already visible. Oracle's capital expenditure jumped to $12 billion from $8 billion in a single quarter as it accelerates data center build-outs for AI cloud services, while its remaining cloud performance obligations climbed from $455 billion to $523 billion, signaling strong demand and a diversified customer base. Financial institutions are also leaning in. One large bank has rolled out generative AI tools to around 170,000 employees with plans to extend them beyond 200,000, and leading industry players increasingly view AI spending as essential infrastructure, even if the near-term profit and loss impact looks like a cost headwind. Macro level, this investment wave is feeding into a more optimistic growth narrative. Recent years have already seen productivity growth above 2%. Partly due to automation and digital adoption, and corporate surveys now anticipate roughly 7% sales and profit growth over 3 years from AI-related efficiencies, supporting constructive forecasts for U.S. equity earnings into 2026. The boom is not without risks. Funding needs are substantial, with credit markets shouldering much of the burden, and stress has appeared in places like Oracle's credit spreads and equity reaction when investors questioned how its AI ambitions would be financed and whether growth would keep pace with leverage. Geopolitics add another layer of uncertainty. Reports of Chinese AI firms acquiring restricted chips through intermediaries and evidence that they can deliver near-parity performance by scaling older hardware raise questions about the durability of U.S. technological advantage and suggest that export controls and tech rivalry will remain a live risk factor for this theme. The third supportive driver is a constructive equity cycle and deal-making backdrop. Strategists see a continued bull phase for U.S. equities into 2026, underpinned by anticipated earnings growth, ongoing fiscal and monetary support, and a capital market cycle that is re-accelerating after several quieter years. Banks and capital markets are central to this story. Large U.S. banks are expected to deliver double-digit earnings growth through 2026, helped by deregulation, strong capital markets activity, and positive operating leverage, while recent easing of leveraged transaction limits is set to expand lending capacity for mergers, acquisitions, and buyouts. Bankers themselves anticipate a surge in debt origination and IPO activity next year. High-profile deals, including a potential $1.5 trillion SpaceX listing that could raise more than $30 billion, are seen as catalysts for a broader reopening of the large-scale IPO market. Leadership within equities is also broadening. There is growing interest in rotation toward consumer-oriented names that lag the AI rally, while financials, industrials, and small caps have all enjoyed periods of outperformance as investors look beyond the original mega-cap winners. Still, this constructive picture is not cost-free. With indices near all-time highs, credit spreads tight, and bank balance sheets ready to underwrite substantial risk, the conditions for frothy behavior are in place, and consensus trades such as rotating from technology into financials risk becoming crowded. Elevated expectations, policy uncertainty for 2025, and valuation concerns in AI-exposed sectors all point to a choppier bull market rather than a straight-line trend. That suggests more dependence on security selection, sector rotation, and deal-level underwriting quality, even as the aggregate backdrop for equity and capital market activity remains favorable. Turning to the headwinds, rising long-term yields and fiscal strains are front and center. Major economies, including the United States, the United Kingdom, France, and China, face a pronounced debt overhang, limiting room for further expansion and raising questions about financial stability and policy flexibility. That backdrop is playing out in bond markets. In the United States, 10-year Treasury yields have climbed toward 4.2% and 30-year yields toward 4.8%, levels not seen since before the global financial crisis, while curves have steepened as investors demand more compensation for fiscal and inflation risk. Persistent fiscal deficits are a key driver. Large and recurring budget shortfalls, rising interest costs on the existing stock of debt, and heavy issuance to fund both government spending and an AI-led corporate capex cycle are all adding to supply pressure and pushing term premia higher. Notably, This is happening despite substantial Fed easing. Even after 175 basis points of cuts, long-term yields have risen rather than fallen, signaling that investors increasingly see fiscal discipline and structural inflation forces, rather than the policy rate alone, as the dominant influence on long-dated borrowing costs. The Fed's renewed bond purchases to maintain reserves underscore this tension. While officially presented as technical reserve management, some observers worry that it marks a step toward fiscal dominance, where the central bank is effectively accommodating large government deficits, which could in turn erode confidence in the dollar and keep upward pressure on yields. For markets and portfolios, elevated long-term yields tighten the room for maneuver. They compress valuation support for equities, raise refinancing costs for governments and corporates, and increase sensitivity of housing and other rate-sensitive sectors, all while leaving less cushion if growth or inflation disappoints relative to today's hopes. Another important bearish driver is policy uncertainty and Fed independence risks. The latest meeting delivered a 25 basis point cut, but it also produced the highest number of dissents since 2019, including calls for both no move and a larger 50 basis point reduction, underscoring how divided the committee has become. Looking ahead, market focus is shifting from the level of the funds rate to the reliability of guidance. A significant number of dissenting votes at upcoming meetings would signal a structural change in how the FOMC operates, potentially weakening the anchor that forward guidance has provided and increasing the volatility of market reactions to each decision. Overlaying this are growing political pressures. There is rising scrutiny of recent Fed appointments, open discussion of investigations, and speculation that a new chair, seen as more dovish, could be appointed, with concerns that such a leader might respond more aggressively to labor market weakness by cutting rates faster. Upcoming votes, and even a Supreme Court case, raise the possibility of constraints on the Fed's independence. Investors worry that if political actors gain more influence over monetary policy, inflation risks could increase, and the long end of the Treasury curve might demand a higher premium to compensate for that uncertainty. At the same time, the quality of some economic data is under question. Technical issues in household surveys and other statistics mean the Fed itself has signaled it will interpret upcoming releases with caution, which can further blur the policy reaction function in the eyes of markets. All of this turns central banking from a stabilizing anchor into a potential source of volatility. While the Fed continues to stress its commitment to the 2% inflation target, the combination of internal division, political pressure, and noisy data adds another reason for investors to demand more compensation for risk and to treat forward guidance as more conditional than in the past. The final bearish driver is valuation excess, leverage, and late-cycle fragility. Credit spreads remain historically tight across much of the market, supporting risk assets today but leaving a very limited buffer if growth slows, policy disappoints, or issuance continues at its current pace. The AI investment boom is a double-edged sword here. Roughly half of the projected $3 trillion in AI infrastructure spending is expected to be financed via debt, concentrated in large technology names and long-duration investment-grade credit, raising questions about market absorption capacity and the resilience of balance sheets if conditions change. Signals from alternative assets also suggest late-cycle dynamics. Silver has surged more than 100% this year and is seen by at least one major commodities analyst as around 15% overvalued, while a combined rally in 10- and 30-year Treasury yields, gold, and silver is being interpreted by some as a warning of potential financial instability or speculative excess. In equities, concerns center on elevated valuations in AI-related sectors and frothy behavior in certain rotations, even as some consumer-facing names look relatively neglected. Consumer spending itself is increasingly driven by higher-income households benefiting from asset gains, while lower-income groups are constrained by price levels, raising questions about the durability of current demand. On the rate side, market participants highlight that it is bond market volatility, more than the absolute level of yields, that poses the main risk to equities. A return to the kind of interest rate volatility seen in 2022 could rapidly reprice risk assets and expose leverage buildup in both public and private credit structures. Against this backdrop, the late cycle environment offers both opportunity and fragility. As long as earnings hold up and policy missteps are avoided, carry and risk exposure can remain rewarded, but the margin for error is narrow, and even modest shocks to spreads, liquidity, or growth expectations could have outsized effects compared with earlier in the cycle. Bringing it together, today's risk picture is one of a still constructive but clearly late cycle environment, where Fed easing, liquidity support, and an AI-powered investment boom keep the upside case alive, while higher long-term yields, policy uncertainty, and stretched valuations steadily erode the safety net. The key watch points from here are the behavior of long-end yields, the tone and unity of future Fed communications, and any signs that spreads, precious metals, or AI-related funding stress are starting to move in ways that signal a regime shift rather than just noise. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.